I want to go over three things today. Business continuity, and that has something to do with estate planning, but it doesn't necessarily have to do with estate planning. It could precede death by quite a bit of ways, but usually it's part of estate planning. I'm going to talk briefly about what is the value of a business and how different ways of coming up with that number. And then lastly, talking about how to protect the value of that business. I've kind of become evangelical about this in the last couple of years, specifically with small business owners, because it's almost always one of those things that people just neglect. And there's a lot of value in businesses out there that usually goes away when someone fails to plan. So it's one of those things people don't want to think about, don't want to talk about, don't want to do anything about, but the decision will be made for you because you will die. So I'm kind of trying to preach the gospel of planning. So in business continuity, again, I think it's one of the most overlooked aspects of small businesses. I don't have any statistics to back it up. Anecdotally, I'm going to tell you that I think that there is a large percentage of businesses that don't do any planning at all. Probably above $50 million in revenue, you start to see people get interested and start planning for those contingencies. But the vast majority of businesses aren't those sizes. So basically, you've got three options when you're dealing with the transition of a business. You have sale to an insider, which usually is a management. Is a sell to a successor manager coming up to the business, family if they're involved. ESOP, which was generally speaking is a separate retirement plan set up under the Internal Revenue Code to actually buy the company on behalf of all of the employees, all of the eligible employees. I don't see a lot of that, but quite frankly, it's a really, really good idea. There's really good tax benefits to doing it that way. It's definitely more expensive, and so for smaller businesses, it may not make sense. But there's a whole lot of businesses that could benefit from it that don't. Sale to an outsider, a competitor, upstream to maybe a regional or national company. If you're large enough, you can attract private equity, where you've got the Rockefellers and the Vanderbilts and all of the Gates monies that are out there that go out and invest in businesses. I'm going to tell you that if your business is not worth more than $1 million, your chances of finding a private equity group to purchase you are none. I mean, it's just not usually worth their time to invest in a deal that is that small. And then the third, which is the default, is that it just goes out of business, which happens unfortunately more often than not. So generally speaking, what's a business valuation? It's a lot like an appraisal on a piece of real estate. You're getting a professional legal opinion that says this is what we think that the business is worth. Is it subject to interpretation? Absolutely. I can tell you that whereas you get a real estate appraisal, to get a 10% variance or a 20% variance is huge between two different appraisers. It is not unusual at all for you to have that 20, 30, 50% difference in opinion on what a professional appraiser will say a business is worth, especially depending upon who they're representing. Although that shouldn't make any difference, it does. Common things you'd need a valuation. The ones we're talking about are gift, estate, and inheritance taxes. We talked about the limit of $5 million. If you're talking about a joint business, most businesses that we're talking about in Oklahoma are not going to be worth $10 million or more than $10 million. When you include all the rest of the estate items, probably not going to apply that you need a valuation specifically for estate planning. But let me give you an example of where you might want to. If you're, again, in that range and you're talking about, well, your business valuer will say that it's $1 million, but the IRS's business valuator will say that it's $2 million, and that's close enough to throw you over the edge. It's a what's the word I'm looking for? Precautionary to go ahead and get it done to have some kind of leg to stand on to say this is what I think it's worth. When the tax laws change in 2013, because they're either going to go back to what they were or we're going to have a new law, that dollar amount may lower and you may need to have a valuation anyway. Selling out, merging, acquiring, or divesting, again, this goes back to the other succession item of you're going to sell to someone else. What's your business worth? I don't see this happen very often like you do in real estate, where we say, well, okay, I got a contract to buy your piece of real estate, and I'm going to come in and we're going to hire an appraiser and I'm going to pay you what it's worth. That usually doesn't happen. Usually what happens is someone's contemplating a sale and they say, well, okay, what is my business worth? And get to a general idea just from a negotiation standpoint of saying, this is where I should start or not. Buy-sell agreements, and this goes back to the succession planning, is almost always neglected in the buy-sell. There's rarely a provision for this other than to say, well, we're gonna do it at fair market value. Well, that goes back to subjective opinion. More and more I've seen in buy-sell agreements where they'll actually identify the process and say, we're going to hire an appraiser, and if you don't agree, then the shareholder can get their own, and then if not, we're going to split the difference, or we'll hire a third and take an average of the three. An appraisal, a business appraisal, in that context is, depending upon the size of the business, but for most small businesses, you're talking about $5,000 to $10,000. So if you're talking about 3 appraisers, you can get some bills mounted pretty quick. So that may not be the best way to define it in a buy-sell agreement, is to just leave it open-ended like that. And then of course people get divorced or prenuptials for marriage, and they want to say, okay, well, I'm bringing this business into the relationship, what's it worth? So the general things on what we look at when we're doing evaluation is, what are we valuing? That sounds kind of crazy, but when we talk about a business, is that business unincorporated? Is it an individual? Is there a corporation? Is there a partnership? Or are there multiple corporations? So defining what we're actually valuing. The purpose of the valuation is critical, because, for instance, if you're dealing with a divorce, depending upon the state, that valuation methodology can be different from state to state. So why you're valuing it definitely makes a difference. When it's being valued as of is just like in a real estate appraisal. You're going to set a date in the sand and say, this is what this is. The last 3 standards, premise and level of value, I'll go over very briefly because they're kind of technical terms. I don't want to go too much into it. Just like a real estate appraisal, there's basically 3 methods of valuing a business. There's income, market, and asset. Very briefly, income is basically taking the business as a going concern and saying, this is what we think that the business will do, and this is therefore what it's worth. This is most common with small businesses because, as you'll see, there rarely is a market. A market is saying, okay, these are businesses that actually traded hands, that were similar businesses, similar sized, similar balance sheet structures, whatever, and this is what they got. Well, when you're dealing with small businesses, a lot of times there's not that information to obtain. Many times with the market, you're dealing with either publicly traded companies that buy smaller businesses, and we have that information, or privately disclosed. There's different databases, but that information is hard to come by and is not always reliable as far as saying what a private business sold for. And then the third one is a cost approach, and that's usually not used as a going concern, or if you're dealing with maybe a hodgepodge of things that would be worth more broken up than they would be as a business. So generally speaking, income is the one that's used most. I'm going to skip a whole bunch of this. And if anybody wants any of this lovely presentation, you are welcome to email me and I will get it to you. So, looking at the income approach, which is one that we normally do, what we're going to do is we're going to say, okay, we've got this business and it's making X amount of money. Usually that's cash flow, but that's not always the case. And we project that out into the future to say, based upon the market, based upon this business, based upon this business's history, we think that over the next 10 years, this is what this business is going to generate. And it's usually assumed at the end of that 10 years, there's going to be some sale of the business, some terminal value of the business. And then we bring it all back into present dollars, and we say, okay, this is what the business is worth as a going concern. Not going to go into that. So, and I'm not going to go into that either, because this is really technical. I will say that, and this is the thing that I highlighted, fair market value is usually the term that's used in what we're talking about in succession planning. It's what a willing buyer will pay a willing seller, and it's not any different than what fair market value in a real estate appraisal would be. It's different than fair value. And I say this to the attorneys in the room because I see this fair value written into shareholder agreements, and I think you are making a mistake there, because it's, as far as I'm concerned, if I'm reading a shareholder agreement that says this is fair value, it's not the same as fair market value, and you may get two different numbers. So fair market value is the term that willing buyer, willing seller. There.